Now we can now deduct any capital expenditures, so any cash capital expenditures. So we go to the cash flow statement and we grab the net cash provided or used in investing activities. So we have that set up there. And then for the change in net working capital, we have to deduct any increase in non-cash working capital. So we go to the operating activities in the cash flow statement and we grab the changes in non-cash working capital. So we are essentially deducting any increase in non-cash working capital. So we can take all of these and fill to the end of the projected period. Now the free cash flow to the firm is going to be equal to, we take the net operating profit after tax, we add depreciation, stock-based compensation, we add other non-cash expenses, we deduct any capital expenditures, and we also deduct any increase in non-cash working capital, even though we see we are adding here. So we can have all of that summed up, since we already have whatever are supposed to be negative numbers in negative and those positive numbers as positive. We can fill that right with Control R. So as you can see, for example, here for the other non-cash expenses, we can see that these are the changes in marketable securities, mark to market, if we believe they are mark to market. So these are the changes in marketable securities. As you can see, we are actually deducting any increase in those changes as it's a non-cash, it's a cash outflow and non-cash item. And also here is the unlevered taxes. These are the cash taxes in that particular period. So these are this is actually the unlevered taxes, the taxes that doesn't take into account the debt capital structure of the business. So that is what we can get from here. And we have this setup here, which we will use later on to, use this to account for the discounted cash flow analysis. So this is the basic for whatever we can get from this free cash flow. So what we want to do now is we want to determine a very, very important metrics for calculating our discounted cash flow analysis. So the weighted average cost of capital is a very, very important metrics in determining our discounted cash flow analysis. Reason being that the cash flows from the beginning of the forecast to the end of the forecast will be heavily discounted to the transaction closing date. So the weighted average cost of capital, it is the cost of capital that makes the net present value of a business to be equal to 0. So if the internal rate of returns of a business is equal to the weighted average cost of capital, then that business is profitable and can be able to compensate its bond investors and equity investors. So the investors get compensated after the business is able to reach that cost of capital, which was used to finance the operations of the business. So we also have what we call the adjusted present value, which is another measure of the performance of a business. So for the adjusted present value, it is in modern finance. Many companies don't use it yet. However, it is a very, very important metrics in measuring the value of a company. So the adjusted present value will take into account non-scale enhancing projects. So a non-scale enhancing project could be a project that doesn't really have a direct relationship to the business risks or the core of the overall business. So suppose that a company is about to take upon a project and the cash flows that will be generated from the project is not correlated to the cash flows from the company's operating core business, then we know that they don't have the same risk measures. And as a result, instead of using the weighted average cost of capital as a measure of the value of that particular project, instead, the adjusted present value method could be used in that case. But for the WACC, which is the weighted average cost of capital, it is very, very important to use WACC for scale and